Hello everyone, it's me the Boss Hog. We're back with another video about building wealth as of the end of November. Honestly, this is my best month-on-month performance since I started measuring. We've also got some new data to share. Let's do it. Alright, so we're going to get straight into it. This is some new data. I actually borrowed this from a combination of two people in Discord, the graph from one of those people and sort of this breakdown between sort of what my investments are actually worth and therefore the kind of running profit from them. First of all, in terms of the reconciliation here, this is some detail I haven't really shared before, at least on these kind of videos, but I think it's good to share. And then, like I say, I basically went through and did this sort of bottom table here that we'll update every month moving forward. In terms of the graph to start with, obviously, like we're just at the beginning of our journey, really. We've still got sort of 2 decades to go. I did consider sort of breaking this down maybe to like 2030, 2035, etc. And then I decided not to. Like, this is the whole point of this video series is, road to 5 million. Hopefully this is going to get us there over that time frame. And so, yeah, even though at the moment it's a pretty small red bar and it kind of doesn't look like we're that far behind, but actually when you sort of look at the table here, we are currently running like 50 grand behind. The main reason for that is just sort of stock market underperformance, and also my pensions particularly are not performing where I would have expected them to be, sort of expecting a 6% year-on-year return, and they haven't managed really anywhere near that, to be honest. Still, though, we're doing pretty okay. There are some assumptions here in terms of invested and worth. So anybody particularly eagle-eyed might be surprised that I've only sort of got 5 grand profit from my pensions. However, this is basically what gets invested. So this is my employer, employee, as well as the tax contribution, right, from the tax man. Unfortunately, I don't really have the data, certainly not historic, to really go back and sort of break that down. So really what we're looking at here is the invested sort of is only about 50% of that's going to be my money. However, I don't have the ability to sort of break that down, but obviously anyone in the UK who knows how pensions work will be sort of familiar with that as a process. So I at the moment have an 8% pension match, which I fully take advantage of, do full pension match, and therefore, and then on top of that, I actually get the tax as well, which is at 40% also. So actually it's more like 150% by the time you're done, right? So again, this is worth considering. The stocks are genuine. That's my current stocks profit across all of my sort of ISAs and general investment accounts as well. House is an interesting one. So the way that this works is that I took the last valuation I had, which I think was in February this year, and then I have a 2% assumption per year on my house price growth. So it's sort of like a combination of the value of my home when it was revalued, plus then that growth, and then I sort of look at my mortgage remaining and sort of do the maths from that. So actually my house profit here is better than I was expecting. I'm actually pretty happy with this. I do live in London. It's interesting as well. I live in one of the poorest boroughs of London, but that means that we sort of haven't been hit by the same sort of very expensive homes that parts of sort of West London have been over the last couple of years and stuff. So flats and homes in my borough are still going up because it's one of the few affordable places remaining in London that you can actually buy a home. So that's had a contribution. And then others here, that's sort of cash and cash equivalents. So it's sort of, savings account, premium bonds, etc. Over time, I do expect to have some profit from this. That would be sort of my premium bond winnings as an example, right? But I've only just really started getting going in premium bonds. And right now, therefore, there's no profit in those as well. But we'll monitor this over time. Yeah, and we'll talk more about this later on in this video, but there are some opportunities for us to close the gap as well. And some of my assumptions, especially earlier in this process, I may well revisit sort of after the next milestone, because I think I've been too optimistic at the start and then too pessimistic at the end. With some of my planning, but again, we'll touch on that as and when. So for now, like I say, this is our actual, ties in with everything else, and then this is sort of what that's made of from this particular view. And I guess the reason why I've broken it out into these categories is because when I was plotting this graph originally, effectively, or the data behind it, this is how I made my assumptions. So stocks were going to go up by 8% annually, pensions would go up 6% annually, house would go up 2% annually, and then other would go up 4%. But that was on the assumption that the other would be sort of all invested in non-tax efficient investments and those kind of things, which actually isn't really a reflection of what I'm doing currently. So that's I think the categorization here again makes sense considering what the data is. on the rest of the screen at the moment. So hopefully that makes sense. Any questions or suggestions, I'm all ears. And again, this is a response to a couple of people in Discord, including ISA Investor as well, who I know a lot of people who watch my videos watch his. He's cool, has a very similar graph like this one. Anyway, that's where we currently are. Let's see whether we're on track to add our 70k to our wealth this year. By the way, probably I should mention, sorry for the sore throat. I've kind of been battling it all week. It not really ever got too bad, but my wife's been a bit poorly again, so that's unfortunate. But hopefully we can power through this with some drinks between cuts. So first of all here, like if we look at the total for November, it's actually relatively modest at like 4.1k, definitely lower than we'd like when you consider that we're aiming for 70k. However, there is an element of explanation here in that we've introduced a new category right at the bottom. I've called it debt arbitrage here, but we could also call it stoozing, which I didn't realize was a term until I sort of spoke with somebody again in Discord and sort of came across this word. So basically, myself and my wife have a credit card. At the end of each month, we pay it off, and that sort of all gets lost because it's basically cash flow rather than wealth. And recently, I got offered a credit card from my bank that provides me with our current account, Santander, and they gave me basically just for asking, well, a credit card of 13.2k credit limit, which is more than I could possibly need. But they also gave me it with a 15-month 0% interest rate, 0% on balance transfers, etc., etc. So the new plan is to basically load up my credit card, do the minimum payment, which is like £35 at the moment. It's like 1% of this debt, and just basically extend this. Now, I did have a conversation with my wife about whether she was comfortable with this. I haven't used debt arbitrage before. I'm also quite new to it and want to make sure that I'm being relatively risk adverse. And the agreement that we have is that we're going to make sure that we have sufficient cover in liquid assets so that if either of us lost our job or one of us died, then we can instantly repay it. And we'll get to that in a second. But basically what we're going to be doing is sort of putting this money between our mortgage offset account, which is a Virgin Money savings account, and our premium bonds. Both of those skins can be accessed instantly and freely, aren't impacted by stock market movements or anything like that. And both of them give sort of like 4 to 5% between, premium bonds is close to 4, and then the mortgage is like 5.2 at the moment. So that's nice. And then basically, because we're not planning on paying this for the next sort of 14 months or so, also inflation will do its thing as well. So I'm sort of relatively confident between those two things, the interest rates that we can get on the savings accounts, as well as the inflation and the impact of cost of money over time, we should be able to get like a 10% return on basically using debt in this way. So I think as long as we're sensible, we'll see that. But this did have a bit of an impact in that, like, this is the first time really that credit card debt has been shown in this way. And what it kind of meant is that money that we would have almost paid off our credit cards in December kind of got bought into November as a negative. So I'm sort of expecting that December is going to actually be a really positive month because some of that offset that we would have had in our kind of cash flow won't be there. And again, like, I bought a big Asda shop for all of our household stuff. That was like £400. That's going to go on the credit card. Etc. Flights to Poland for Christmas as well on the credit card. So that's going to be the approach. We'll keep an eye on it. And again, because now we're using this credit card facility as part of our wealth building, for me, it makes sense to include it on our wealth video. We previously didn't because, again, we weren't using our credit cards for anything other than cash flow. But now that we're using it for this debt management and then debt arbitrage, we will start talking about it. So we'll monitor this. But yeah, the plan is to get this up to like 13.2k as quickly as possible, honestly. So everything is going to get loaded up, and we will keep an eye on it with our other investments and etc. The good thing about this is it has allowed me to get a bit further ahead in terms of our non-ISA investments. You can see it here, but really what that means is premium bonds. So the current plan is to put sort of 500 to maybe 1,000 in each month in premium bonds. Last month we were able to do 1,500 in premium bonds, and then another 200 into the Virgin Money account, as well as sort of paying in £3,300 into the ISAs, which again was ahead of budget of sort of 2,700. So that was a nice couple of additions. And again, as already touched on, I'm expecting December to be a really good month as things come in. So you can keep me honest in a month's time and come back and we can talk through that. But yeah, that's the high level. Again, we're on track 70 grand at the start of the year, and I think we're going to have a really strong finish in December. So I think we'll comfortably beat our 70,000. But yeah, really pleased with this number because obviously this is the bit that I can control, the market and everything else not control. So this feels really positive, and yeah, very happy with these numbers, to be honest. All right, so in terms of the debt arbitrage, first of all, maybe it's clearer to see here. I think it is, honestly. So yeah, we've got our debt arbitrage here. So this is what's currently on our credit card. Again, that's basically a month's worth of credit card for my wife and me. And then yeah, the Polish trips, a big shopping trip, and basically some normal, living expenses, basically travel, etc. So that's that 3 grand, and then we at the moment we've got 3,800 here. But what's going to happen is once my December big bills come through, so things like my daughter's school fees, mortgage mainly, the money that's currently in our Santander account will sort of go down to about 3,000, something like that, 2,500, and then the rest will be sort of put into the Virgin Money. And again, that will then reduce our mortgage interest payments. So we basically be able to pay our home quicker because we're slightly overpaying on our mortgage at the moment, which feels good. So effectively, we've got 3,800 in our debit and 3,300 in our credit. So that keeps me honest to my wife. So that's a good start. Honestly, broadly positive. A lot of the wins were sort of caused by the stock market. I can't really take too much credit. It also helped, again, that we could sort of get reasonably far ahead in terms of some of the things like premium bonds and mortgage offset, but honestly they haven't really started going yet, right? We again, for anyone familiar with premium bonds, you know how it works, and that you have to have the stuff in there for a full month before you qualify for the draws, etc. And again, the mortgage offset will happen, but that's sort of happening in the background as we will essentially pay off our mortgage quicker. So yeah, that was good. Most of the win here in the kind of the performance month on month came from just great stock market performance. And again, this is by quarter, right? But it's been hovering around 400,000. But last month it was less than that. So we're actually up almost 25 grand in a month, which feels really positive as well. And you can sort of see the breakdown over here. So not much else to add that I haven't already said. And yeah, we'll move on to how this is looking against our targets. All right, so first of all, I've mentioned a couple of times in previous videos as well that I'm not loving the March figure, which I'm definitely going to miss, but it's not just that. Again, I think I've kind of put too much pressure in the early part of this, not really giving enough count to the nature of compounding. But however, I want to keep myself honest, and I still think that we won't miss it by too much. So I think the plan here is we're going to hit our 500k target whenever it is, maybe like June, July is my expectation at the moment, and then we'll revisit the hockey stick, the way it sort of curves up on the graph, but we'll leave as is for now. So that's going to be the plan. Yeah, we are adding about 6k again. November was a bit depressed because of the situation with the credit cards being -3. But broadly speaking, we're adding 6k per month, and that's, remember what we need, right, to hit our 70k for the year figure. It's basically 70k divided by 12, which is just a smidge under 6k. So that's where we have to get to. So that's our capital contribution, and then we hope that the markets and everything else perform in order to hit our run rate. Also, there is some opportunities for catch up. My wife gets a bonus in December. I hopefully get a bonus in like April. Neither of us know our numbers yet, but we have some idea, right? We can see how the company is doing and that kind of stuff. So they will not be immaterial. They'll probably both be 5 figures, although on the lower end of 5 figures. But they'll definitely make a contribution. And I haven't assumed any bonuses or indeed pay rises. I don't think I'll get much of a pay rise. Sorry, I think I'll get a fairly token pay rise. But my wife is going for quite a chunky promotion at work, and may well get a fairly significant pay rise, which will have an impact obviously next year rather than anything in December. So we'll see. And yeah, a big bump month on month, so that feels good, as already touched on. It's interesting though with the targets, to be honest with you, because because our wealth went up 25 grand in a month, obviously that's really good. So all of the percentages that are linked to have net wealth improved, and some of them quite substantially, especially the one to 500k, as we're now sort of above 80% on that journey. But the dividend targets actually went backwards, and that's because sort of the target works on a 12-month rolling. And unfortunately, last month we missed it by 50p, right, which was kind of frustrating. But it also means that because November 2023 was lower dividend than 2022, it basically means that we fell further back from our rolling 12 months. So really frustrating. We're still sort of doing okay. Again, I no longer class myself as a dividend investor. I'm basically just trying to grow as much as possible, as we'll detail very shortly. But we're still doing okay. It's just annoying I can't complete it. And honestly, I don't think I'll be able to complete it for a couple of months until sort of some of the UK dividends start coming in again and sort of top it up in sort of Q2 maybe next year. But we'll see. We do have a few more ETF dividends starting to come in as well as we build up positions there. So a little bit annoying on the dividend actually went backwards. So we fell back from like 99.8 to 95. So, but that's the reason for that basically. All right, so very quick here then. So as I touched on, I'm pretty happy with the 3.3k in November. That's this figure down here. Originally, I'm budgeting 2.8k and was able to do an extra 500 fairly late in the month once I sort of got to see what was happening with everything. And yeah, it's really good. We've already completed my ISA. We've got 11,000 left to go on my wife's ISA. So as long as we can keep up sort of £3 a month for the next 4 months, we will basically top up my wife's ISA as well. And honestly, topping up the 2 ISAs is like our most important financial goal, just because we plan on retiring early and retiring well. And anything in ISA is not taxable for income tax, which is key basically for our sort of relatively fat and wealthy retirement. So that sort of makes a big impact. Not, basically having probably the better part of like £100,000 a year income from our ISAs, and none of that will be taxable, right? So that is a significant style of living, pretty much wherever we want to go, within reason. Obviously, we won't be able to go sort of like chartered jets and stuff like that, but within reason, we'll be able to have a great retirement. So that's our most important aim. Very small withdrawal this month. This is our Games Workshop dividends. This is basically just so we can see some income starting to hit our bank account. It's also outside of our ISA already, so it's no problem withdrawing it. It doesn't like prevent any kind of snowball, and it just goes back into our bank account. It's just, again, so my wife can see it. We sort of had a bit of a joke about it for anyone who knew, and my wife was like, cold hard cash, right? Like, what, these are all ones and zeros. Let's see cold hard cash. So this is cold hard cash. Games Workshop do pay dividend 4 times a year, but it's not quite exactly every quarter. This one was relatively small, and then we'll see another one in, I think it's February, which I would expect to be a little bit bigger, but we will see. Again, it's a fairly, like, Games Workshop just give you money when they feel like it. It's not a traditional dividend growth or anything like that. They specifically say they just distribute surplus capital. That's what they say. So we live with it, and again, we're not dividend income, so it doesn't really matter. And yeah, again, for anyone who's new here, this is you can see some history with the withdrawals in the past, but really that's just where I was sort of not aware of exactly how the accounts worked between the ISA and the general investment account. So solid, and again, our net total is here, but the important thing is like the 3.3 that's going into the ISAs, the net is overall on the shares, right, out of the general investment account. All right, and then lastly is the dividend shares. So November was pretty modest, honestly, just £97. You can see as well against November 2022, it was 244. So a pretty big fall, but the main reason for that is because my Gamma dividend got paid in October this year, so it went in with the big one. Also Phoenix in that month as well, so a pretty big month in October. Whereas the year before it was paid in October, so it's just pretty tough comparables really year on year. Again, we just roll with the punches. We're not relying on dividend for income. It's very nice to receive it for sure, but when Gamma's my second biggest position, and although it's not exactly yielding huge at the moment, it is a dividend growth play. So, and again, just I have so much of it that it does make a difference at these kind of volumes. So that's the main difference there. We have changed approach, but actually whenever I do this particular data and I can sort of see where the percentage of my dividend comes from, I am sort of quite surprised that we're basically looking at, like a 30, 30 and then 40% because it doesn't necessarily feel like I'm sort of accelerating in that way, but this kind of does prove it in terms of the numbers. Like I've had 2 years where it was like 30%, and then the last 12 months have actually been sort of closer to 40% of the total dividend I've received. So it gives me a different view, honestly, and this kind of does help me feel like we're starting to build that dividend snowball, even though other views, especially by discrete years, don't necessarily give that. But as we start to sort of align discrete years and maybe we start to see that a little bit more. It's kind of interesting. Yeah, so as already mentioned, and again, we had a big start. We used my wife's, we had a savings account for when my wife went on maternity leave. We weren't sure what the plans were at the time, so we had a big cash balance, and we just started in late December 2020. So we didn't have any dividends before January 2021. So that's the reason for that basically. But this is the breakdown. Yeah, just a few shares here. This is the JP Morgan Emerging Markets Investment Trust, so one of the ETFs, SML, I think everyone knows, and Redrow, my house builder of choice, who actually went green this week. So that was nice to see my Redrow position going green. Again, I remain bullish on the economic fundamentals of UK house builders, just basically not enough supply, plenty of demand, and even therefore with fairly high interest rates at the moment, I just don't believe there's enough supply coming to the market to address anything. So basic economics tells me that the equilibrium price goes up, and therefore that puts a floor on any falls. And again, I keep seeing these news articles where it's like, market surprised by modest house price increase, or I mean, it's okay. I'm not seeing any kind of crash or anything like that, even though Redrow's results weren't fantastic. They also weren't terrible either. And again, the house prices for the share prices for house builders is so modest. It's very undemanding. So it's basically a value play as well as a sort of dividend income. A lot of the house builders are well covered and still produce pretty good yields. So all good for me. All right, and then lastly, work in progress. I'm ashamed to say I haven't made any real progress on this. I haven't tried. No one's been in touch with me. I'm actually not sure what's happening with it, and I need to sort of reach out to Hargreaves Lansdown and understand what's happening. Last time they told me they'd done everything and they were basically waiting for feedback from Nutmeg, so we'll see. Next up, this is kind of a nice to have, but basically my my personal pension, the consolidated pension, is now at the kind of level where it's starting to cross thresholds into management fees. So basically some other providers offer better investment rates for management fees, and I'm considering sort of moving, but I haven't really done any work on this yet. I don't think it's going to be material, but it may well become material as my consolidated pension pots basically increase. So that's something for the future. This one I actually just added since last month, but it was something I was thinking about. Probably should have spoken about it a month ago, but actually this just happened really quickly. Like I say, I kind of just like got a little pop up on my Santander login, like, would you like to apply for a credit card? I was like, sure, let's see. And the main reason was just me thinking that actually I could consolidate the transactions into a single portal, and it would be easier to manage rather than having to go to my credit card. But then when they sent me it, again, I didn't ask for 13.2, which is a weird credit limit as well, right? I didn't ask for 13.2k, they just gave me it. So I was like, well, I might as well just abuse this now then. So, and since then I sort of read up a little bit, made sure I was comfortable with how it worked, and again, agreed some principles with my wife. So that's good. And then the stuff that's done, again, this always makes me feel good. There is an update in that I decided to move the Enterprise Investment Scheme and Venture Capital Trust to done. I've basically done the research. I think it is something me and my wife really want to do in the future. It's just not a huge priority at the moment. Again, the ISAs are just such a good way to do it. We've still got pensions, we've got premium bonds as well, and then we'll probably get investments of these kind of risky nature. For anyone who's not aware, these are basically, they can be in single companies, but the ones we're looking at were like pooled investment schemes. That's very important as well, right? Because my wife works for private equity, and I'm no longer allowed to buy individual shares. However, I did speak with basically the compliance team at my wife's organization, and they said that as long as the investment is pooled and I don't have any say in how the EIS or VCT schemes are investing my money, actually I'm perfectly able to invest in these. I have to declare it, but as long as these are pooled investments, then I'm fine to invest. So I got the sign off from that perspective. And yeah, basically we get an immediate income tax write-off for this with extremely generous caps that will never hit. So even though they're like high risk and they have a fairly sketchy performance record, I would say, the attractive nature of basically having an income tax write-off equivalent to your investment is very attractive. So there's some good stuff there. So we'll explore that and get on top of it closer to the time. Probably talk to a proper qualified advisor. But again, I think honestly this is like several years off. until we get ourselves in a kind of even better position before we start exploring what's effectively quite risky early stage businesses that need funding. So it's cool. I think it's super exciting. I would love to do more of it. But for now, I'm kind of happy investing with things like Scottish Mortgage and basically having my exposure to small or private companies through that scheme. So honestly, November, pretty good month. I mean, a very good month in terms of the wealth building. I can't take too much credit for that because, again, the market was very friendly. I think everyone felt it. I think I had just under a 10% return in my ISAs. Pensions were solid. And yeah, we sort of, again, introduced our debt arbitrage. That hasn't really showed just yet in the November figures, but it will show in the December figures moving forward. And again, that makes me pretty excited as well, just to be, not quite abusing. I'm not sure if that's the right word. Using a debt facility in this way. So again, we'll keep myself honest, and hopefully we'll go from there. So thank you very much for watching, everyone. I've been the Boss Hog. Bye for now.